Welcome back, ladies and gentlemen. The universe of alternative investments in equity does not limit to PMSs only. Another industry that is growing today at even faster pace is the AIF industry. AIFs, or alternative investment funds, are a vast category in itself, and one of the prominent ones within is a long-short category of AIFs. Now, these funds use complex strategies to hedge equity portfolio and try to significantly contain the downside. Given the rise in volatility, uncertainty, and ambiguity, a lot of investors are looking at long-short AIFs with an approach of capital preservation along with capital appreciation. But the key question really then is, do these funds actually make sense for equity investors who have a long-term view, and how have these funds actually performed in comparison to long-only funds over the last 3 years? To understand this and much more about long-short AIFs, our next panel will discuss the pros and cons that equity investors can learn from the last 3-year experience of equity long-short funds. Ladies and gentlemen, let me introduce the eminent panelists to you. We have with us Mr. Harsh Agarwal, who heads the alternative strategies at Tata AMC. He has more than 18 years of experience in equity portfolio management as well as research. Mr. Harsh joined Tata Asset Management in November 2018 as head of alternative strategies and launched the maiden hedge fund from the House of Tatas. And prior to joining Tata Asset Management, Mr. Harsh worked largely in hedge fund setups and proprietary trading firms. Mr. Harsh started his career by managing family investments and shortly moved on to providing equity research and advisory to Equitech. And he's an MBA Finance from Symbiosis, Pune. He has also done courses in Certified Portfolio Manager and Certified Treasury Manager from the Institute of Chartered Financial Analysts, India. In his leisure time, he likes to indulge in sports and plays chess. We extend a very hearty welcome to Mr. Harsh Agarwal. We have with us Mr. Rajesh Bhatia, ladies and gentlemen, the MD and CIO at the Investment Trust of India Long Short Equity Fund. He has over 30 years of investment experience in Indian equities, of which the last 14 years have been in alternative investments, long-short fund management. Prior to ITI, he was the CIO Simto Investments, which is a subsidiary of Tata Investments. He has been the co-founder and CIO Heritage India Advisors, Indian advisor to New York-based Heritage Capital, an India long-short equity fund, which was nominated as among the top 5 funds in India for its performance in 2010 by Eureka Hedge. He was the Senior Vice President and Head Portfolio Management Services, Reliance Capital Asset Management, started the business unit for the firm in 2004. He's a commerce graduate, HR College of Commerce and Economics, ACMA, Cost and Management Accounting, and has completed the CFA program conducted by CFA Institute, USA. We extend a very warm welcome to Mr. Rajesh Bhatia. We have with us Mr. Vaibhav Sanghavi, the co-CEO at Avendus Capital Public Markets Alternate Strategies LLP. He comes armed with over 17 years of experience in managing funds across leading financial institutions. And prior to Avendus, he was part of Ambit Investment Advisors. In fact, he was part of Ambit Investment Advisors Limited from October 2008 to September 2016. His fund management experience prior to Ambit was with DSP Merrill Lynch from October 2005 to September 2008, where he was instrumental in building the proprietary trading team, managing and advising over $1 billion of capital. And he has also worked with HDFC Bank as part of Treasury. So we extend a very warm welcome to Mr. Vaibhav Sanghavi. And ladies and gentlemen, this session will be moderated by Mr. Kamal Manocha, who is the founder and chief executive officer at PMS AIF World. He is responsible for driving the overall business across both wealth and content management. Over the past 3 years, PMS AIF World has conceptualized various innovations under his capable thought leadership, the most recent one being the quality, risk, and consistency framework created to deep dive the space of portfolio management services. Mr. Kamal Manocha brings with him over 18 years of experience, holds a master's degree in management and a bachelor's degree in economics from Hansraj College, Delhi University. Ladies and gentlemen, a very exciting session ahead indeed. I'm going to hand over the proceedings to Mr. Manocha. Sir, please take it away.
Thank you so much, Aishwarya, for setting the context for this session, and welcome everyone. I took over this session to moderate, because every day, when we take long short funds to our clients, there are various realistic questions that come in front of us. And rather than kind of, getting it moderated from somebody else, I thought I should directly moderate this panel to get answers to some of those real questions. So my first question, that I would like to ask from Harsh, when it comes to investing into a long short fund today, in the context of an investor, put yourself in investor's shoe. What is it, that one should kind of equate it to? Is it a substitute to a debt fund, or is it a substitute to a balanced equity fund? Is it a substitute to a long only fund, or it's a new asset class, which needs to be seen with different risk and return thought process? And you personally, if you are a investor with a 5-year horizon, would you like to put money in long short fund? For what reason would that be?
Yeah, Kamal, that's a great question. So I personally don't think that in Indian context, hedge funds are a different asset class. I think that, most of the hedge funds that have been coming up in India, they are positioned around the mutual fund categories. So whether we have a debt fund, whether we have equity savings, whether we have balance advantage fund or aggressive hybrids. There isn't any long short fund in the country which is as risky as Nifty. There are somewhat, 1 or 2 notches lower risk. So there is the positioning of all the long short funds is by and large on these broad categories only. And the question is there a merit in investing in these long short funds? The answer is absolutely yes. In fact, there is sufficient data, and you yourself aggregate, the whole analytics and data for the long short funds. And there is sufficient evidence that, if you're comparing, let's say, a debt fund to a long short debt oriented fund, you will see that there is a very, very sizable alpha over what mutual funds are doing or what an investor can get in bank FDs or let's say direct bonds. In fact, I think if you look at, let's say, last 1 year's performance, the 2 best debt-oriented long-short funds have given about 14%. Coincidentally, 2 of the fund managers who are managing those funds are sitting here. And this is compared, 14% is compared to, let's say, 5 or 6% that bank FDs or, let's say, liquid funds would do. So there is a huge alpha over, let's say, what a fixed income oriented fund could give. Let's say if we move towards equities, there are conservative hybrids, there are aggressive hybrids, and you have long short funds, which are positioned on similar volatility terms, similar downside risk protection, and so on. Even if you were to compare the long short funds to these categories, let's say equity savings or BAF, you have long short funds who are tremendously outperforming these broad categories. In fact, we also have a very conservative lowest risk equity fund that is not only just beating equity savings, but it is handsomely beating Nifty as well now. So, to your point, whether long short are just for risk management and downside protection, in fact, the answer actually lies in this question itself. If you are able to protect the downside and you do not participate in the negative compounding, then over a long period of time, your compounding will be much, much higher. So from investors' perspective, they should be looking at these funds even from appreciation perspective. So in fact, I think the longest hedge fund in the country, it's beating Nifty, I think by 4 or 5% right from its inception, which is probably 8 or 9 years old. So there is now sufficient evidence that there is a very, very strong merit in investing in these hedge funds. Just to give you one more context, we kind of ignore the risks when we talk about, long-term investing, and long-term investing in equities makes, fascinating returns. So let's say take returns from 2010 onwards, probably in the last 12 years, Nifty and small caps have given about 12% CAGR returns. The funds would have done more or less depending upon, how much alpha they have made. Mid caps have given a slightly more. So even if you're looking from equities from a very, very long-term perspective, probably equities will give you about, 12, 13% odd returns. Now, let's say if you take a aggressive or let's say a good risk managed long short fund, can it give me better than that, ignoring the volatility and risk management? The answer is absolutely yes. And investors should consider that. Why, a long short fund, despite taking low risk, is able to generate high returns. I think that is the critical factor. Now, let's say for a long only fund, there are certain macro risks that are developing. There are some company specific risks or sector specific risks that are developing. So it could show up in the portfolio and the returns could get, subdued. But for a long short fund, a risk is an opportunity. It's an opportunity to make money by shorting that stock or that theme. So for long short fund, the risk actually compound when these risks expand, provided you are able to capture those, identify those risks and able to make money out of it. Which is why the long short funds, ideally over a long period of time, the aggressive ones, they should beat Nifty hands down. My broad guess would be they should beat at least Nifty or equities by 5-6% compounded, without even having to take that kind of a risk. So that's my fair and honest. Thanks.
Sure, thank you so much, Harsh. Moving on to Rajesh, the next question, which subsequently comes to my mind is that, understanding the human psychology. One is normally, whenever decisions are taken, one kind of, takes those decisions less, I would say, with mind, but more with heart, especially when it comes to investments. I have been doing, client dealing for last 20 years. I can tell you, investors base their decision probably mostly on trust. This is the only element, and trust is an emotional factor. And when it comes to talking about a long short fund, it actually appeals human, I would say, aspirations, in the sense that every individual wants to take lower risk, wants protection on the downside, and at the same time wants enhanced return on the upside. As Harsh also kind of claimed that on the upside returns are enhanced, on downside returns are protected. So this is actually the best of both worlds. But does it actually come across when it comes to an outcome in terms of results and terms of experiences of investors? Because you are only dealing with long short investors. We are dealing with all types of investors. But I'm wanting you to explain what are the real experiences of investors in terms of returns, as well as risk-adjusted returns in this regards.
Hey, so I think your question is, how come you're taking lower risk, and how come you can make still a very attractive return, and probably even a better return than an equity fund, right? So I think while the theoretical construct is that higher the risk, higher the return, the real world experience is quite to the contrary. In fact, over a long period of time, low beta stocks have outperformed even high beta ones. And Warren Buffett is a great example of that, right? So the theoretical construct really doesn't hold in the real world. Now, I think as Harsh pointed out, the evidence is out there. There are hedge funds now in India with a long-term history, and which have proven to you that they can beat markets with lower risk and lower return. So it is not a theoretical construct that we are talking about. There is real evidence out there. I think I think the assumption that you're making is that how can I lower my risk and yet get a superior return? And what I'm telling you that evidence at this moment of a long short fund tells you that you can do that. And I think you're underappreciating the value add of protecting downside. I think Harsh also kind of alluded to that. Look, I'll just give you some mathematics on that. So let us say if I have 100 rupees and the market goes down 30%, right? And a long short protects capital is at 100 only, and that long only goes to 70, right? And that now for that 70 to come back to 100 requires almost a 50% return. Now, people will say, yes, you're protected the downside, but you are not going to find the bottom. True, you're not going to find the bottom. But let us say, even if the long short fund is able to capture the 25% or 50% of the return as the market goes up, the long short fund then becomes 125. And while the long only comes back to 100. So I think the mathematics of declines is an extremely important component of understanding this compounding. In fact, it is said that this is a very appreciated investment principle, that to compound at an attractive rate for the long term, first you need to protect downside. All the long only managers would follow Warren Buffett. Do you know what is his first investment principle? Rule number 1, don't lose money. Rule number 2, never forget rule number 1, right? That's because of the mathematics of decline. Third point, I think I want to kind of bring out here is what is the environment that you're walking into? What was the reason why markets went up from April 2020 onwards? It was because of the unleashing of a lot of liquidity by central bankers, right? Now, what is the reason why markets have topped out in September and October 2021? Because of the fear that interest rates and liquidity is going to be taken out of the market. This is now a macro-driven market. Volatility as you move forward for the next 3 to 5 years is here to stay. So the markets are being more influenced by P changes rather than EPS changes. And therefore, you require a strategy which can take advantage of this volatility as cycles get shorter. These macro-driven markets are not going to stop today. This is an environment that is going to remain for the next 3 to 5 years. So you require a risk-adjusted strategy as you move forward, which can benefit from the downside volatility that takes place. And again, I think Harsh also alluded to this. While there are greedy investors, as you point out, the last 3 years, small cap, mid cap return is probably a 14% CAGR. That sounds like 12% post-tax return. So people must know that their long-term earnings are really, if you make 10 or 12%, 10% is probably what the large caps have done post-tax, and mid caps have done 12% post-tax. So while there is a feeling that equity IRR should be 18 or 25%, the actual evidence is quite to the contrary. So in that context, 12, 14% return, this value add of protecting downside certainly helps you in a much better way as you compound over the long term.
Right, Rajesh. So basically, we reiterate the fact that this is just not a story. It is, backed by data, and it has a science behind it, and it is possible. And actually, this is also a method to create wealth. Moving on to Vaibhav. So, one, I would want you to give your views also, on what Harsh and Rajesh has mentioned. And also, from the perspective of, again, I'm reminding that, from putting yourself in investor's shoe today, I, as an investor, want to select either a long only fund or a long short fund. Now, when I want to select a long only fund, maybe, I will have this thought in mind that this fund may perform or may not perform, because for a long only fund to perform over, say, next 3 to 5 years, the environment needs to be conducive. The choice of fund needs to be right. The underlying, portfolio and the people behind that portfolio needs to be good. But when it comes to selecting a long short fund, the outcome may not be performance versus no performance. The outcome may be less performance, maybe more performance. Because as Harsh and Rajesh have mentioned, that a long short fund will contain downside, will try to enhance upside, and when it will try to do that every day, obviously, it will give some performance. So is that argument correct, from the context of an investor, or there is something, missing here?
So Kamal, I think what we've seen, Harsh and Rajesh both have made pretty relevant points. In my experience of managing, a hedge fund over the last 9 years and using a long short tool to manage kind of funds over the last 17 years, actually, what we have learned is basically that long short, and I'm just taking a step back here, is that a long short methodology is just a tool to kind of, deliver in terms of the risk and return strategies across the risk curve. A long short tool can be used as a strategy to be very conservative. At the same time, a long short tool can be used for a strategy which can be, aggressive in terms of targeting an equity or equity plus return as well. So when we talk about, a risk-adjusted returns, we always say that how can we optimize, the risk rather than, or optimize the return rather than maximize the return. And when we say that, is basically that what we do is that for a conservative investor who is looking for that kind of return, and to some points which Harsh also mentioned, is that if we are able to generate returns which are debt-like returns or debt plus kind of returns with a risk profile which is completely equivalent to debt, then an investor has a possibility or has a great value addition to the portfolio by generating 200 to 250 basis points over the benchmark debt kind of returns. At the same time, the same long-short instrument can be used for an investor who is actually looking for an equity or equity plus return. So when an investor is looking to invest into, say, for example, equity return, he's already aware of the risks about the equity. And if he can use long short as an instrument to kind of enhance the return vis-a-vis your equity while having some more risk, then again, it's a value proposition. So what you are essentially doing is basically you are actually maneuvering around the different components of risks and return to kind of give a very optimized and a great experience for an investor. We have to understand that an investor always comes with a psychological baggage, and as you also mentioned, that people get emotional about when they kind of make an investment decision. And if you also go back in history, post 2008, when the global financial crisis kind of happened, subsequent to that, over the 5 years or 6 years, virtually because of the shock they have gotten in 2007 and 8, they virtually didn't come to the markets when the maximum amount of return kind of happened. So it is great theory to say that to invest for a 10-year period or a 15-year period, you will get 11% return and 12% return, which by no means is bad return. But the point is basically because of the behavioral aspect, how many investors would be there who would be able to navigate through that kind of volatility? And long short exactly does kind of what it aims to try and help the investor navigate through that kind of volatility and sustain onto the investment to make a longer term return. So you have to look at both the components in terms of the risk, the return, how do you optimize that, and how it kind of fits well into an individual goal of making a return over a longer period of time.
Right, Vaibhav. So, the first set of three questions basically reinforce the conviction towards investing in the long short strategies. So now the subsequent thing, I as an investor have now I am more attracted to long short as a category after your answers. But I would want to understand, the long only fund managers, which we keep hearing always, they always have taught that timing the market does not matter. Time in the market is more important than timing the market. So does this hold true for long short selection also? And do you also kind of believe that yes, timing the market does not matter and time in the market matters more? Question to you, Harsh, first.
I think, it's a great question. Personally, I would feel that I really don't have great skills in timing the market. So I really don't, work around that. But I have seen that some of the managers, and I think both of them, Vaibhav and Rajesh, they are superb in timing the market. It's really not my skill set. So, I don't, have it displayed through my funds. So I tend to maintain the mandate. I have both long and short portfolios running simultaneously. So my focus is purely on the stocks. So I also have a different perspective to long only, long only portfolio management. So, while people say that, time in the market is important, not timing the market, I think timing the market is very, very helpful if we can do it. Many of us do not have that skill set. But I think if somebody can time the market, I would be very, very happy to, lend out my money to him. My focus, or any long only fund manager's focus rather, should be, to get alpha. Markets are always going to go up in long term. The trajectory can be debated, whether it will be 10-12% or 15-17%. We can always debate that. But a job of the fund manager, whether long only or long short, is to get alpha. If the benchmark is going to give me 15, the manager should give me 17 or 18. That's a broad objective. For long short, your alpha gets displayed on both long and short side. Theoretically, let's say if I have a long only book, I can actually compound the returns by having a pure long only book and a large short book. The short book will also make money, and the long only book will also beat the benchmark. So, from long short perspective, you can, extremely enhance the returns depending on the risk profile of the fund and the investors. So, to come to this main point, which is that every fund manager or every fund house will have some sort of a different skill set. They should capitalize on that skill set and build products or strategies around that. So there are people who focus on timing the market and they execute it very, very well. And I am very, very impressed by them. Personally, I can't do it, but I am very impressed by the people who can do it. And it certainly makes a lot of sense. I just think that people who say that timing the market is not important, I think somebody can do it. It is extremely helpful for the investors. It's just that it is just too difficult. So very few people will be able to do it. In our funds and in my kind of work style, I focus on alpha rather than timing the market.
Sure. Moving on to Rajesh, what are your views in this regard? Do you see, first of all, the claim given by long-only fund managers as timing does not matter? Do you believe in that? And what is your style in this regards? And what is your, I would say, uh, right? What is the right time as per you? If anybody has to take decision of investing into a long-short fund.
You're right. So, first of all, this is an alternate asset class. So I know that there is continuous comparison with a certain equity fund or a fixed income fund, but we must know this is an alternate asset class. It's an asset category by itself. And you must focus on the virtues of what the asset category brings to the table, right? Now, I can tell you that in our 4.5 years, and even I've been a hedge fund manager for 15 years, but at least in the 4.5 years of our existence as a fund, there were 3 sharp drawdowns that took place in the fund. In each of the cases, we were able to protect downside. The last one being the last quarter, when the markets are down 10% or so, again, we have been able to protect capital. So there is a certain consistency and a value add of protecting downside and yet making an equity type return. Now, where does this become seriously relevant, right? So I think, Vaibhav alluded to a period of 2008. That was the worst year for equities in India in 30 years. The markets fell 55%. Long-only managers fell, I think, anywhere between 65 to 85%. Let us say they fell 75%, right? So if you gave money to a long-only manager in Jan 2008, he was able to give you your principal back in Jan 2015. 7 years of no return, lost decade of returns. That can take away compounding for 30 years if you don't have a adequate return for 10 years, right? That's long-term enough. Now, if you gave money to a long-short manager, if they lost 1 or 2%, they were making and compounding on a higher base, right? So that's when you seriously feel the value add of protecting downside, right? And, as Seth Klarman says, you can all your 30 years of return can go for a toss if on the 31st year you decline by 50%, right? So if you are, let's say you compounded at 15% for 30 years, and if you lose 50% in the 31st year, your 30-year compounding becomes 7.5%. So again, the virtue of protecting downside is extremely important. And my belief is, given the environment that you're walking into, which is macro-driven, fragile environment, the need for a risk-adjusted strategy could have never been greater.
Right.
And I think, Kamal, I must tell you that we speak to, Vaibhav, I and Harsh talk to a lot of HNIs, right? And please ask them, right? So rather than people in the industry, you should go and ask investors. They will tell you, I'll kill for 12% post-tax, right? And if, once you are of a certain size of net worth, you're not looking for a 30% compounding for your entire net worth. You're first looking to protect your capital and make an adequate return. So a lot of serious HNIs that we speak to would kill for a 12% post-tax return.
Sure. The only, issue is, I fully agree with you, this is a different alternate asset class, should not be kind of, compared with long only as an asset class. But the thought process that investors, as their mindset is emotional.
No, as Kamal, to that, as more history gets created, as we have more players in the long short equity fund, a lot of this will sort itself out. So this is, I think the mutual fund has done a phenomenal job with SIP. That is the right investment principle to approach equity markets, right? So so clearly, that has happened over a period of time. So I think as more history gets created in the long short space, people will understand the virtues of what we are talking about. And I think it is resonating with people. So I can tell you, my sense is that industry is at an inflection point. Like people are appreciating, given the volatility that they've been seeing, people are appreciating the virtues of what I'm talking about.
So are you kind of trying to hint that, for history to be created, one more 2008 is required?
Not required. I mean, you'd be surprised. There's enough pain between October and today for investors. So I don't think you require a 2008. But if funds are down calendar year to date 16 or 18%, and if you are not down, that is a significant value add to an investor.
Absolutely. To this, exactly that was my question. That people who invested into long only funds in October, November, December last year, today they are down 16, 17%. And today, if I tell them that timing the market is not important, time in the market is important, obviously they take it offensively. I will not say that, but the thing is, everybody says that. All long only fund managers say that timing the market is not important. But in your context, in the context of a long short fund, I'm moving on to Vaibhav, right? Do you believe that yes, in context of long short fund, timing absolutely doesn't matter?
So I think, Kamal, I mean, it's a question with many facets here, because when we talk about timing, I would always resonate timing with more on asset allocation rather than within a particular strategy. Why do I say that? Is basically when we talked about or when we saw 2020 COVID kind of struck, right? We were at a valuations which were, say, on a market-wide valuation about 1.7 times price to book. Now, when that was the kind of valuation, people were scared of investing into the markets. We have to understand, and again, marrying with the investor psychology, that when you get those kind of cheaper levels to kind of invest it, those are the times where you are most scared to kind of invest, purely because the narrative around those kind of periods or timing is so pessimistic that you have all negative news all around. So people would not probably ideally come and invest aggressively. So while it is extremely easy or good to say that you can go and time the markets and probably enter into those kind of phase of markets and you can make supernatural returns, one has to understand that it is not going to be consistently possible doing that. One has to accept that. Now, if you kind of accept that, how do I kind of start sustaining myself across the time periods, right? And sustenance, as everybody has been saying, that sustenance is the most important task. A long only manager, when you will come and invest, and again, going back to the same example, when you got maximum inflows in 2006 and 2007, 2008 happened, right? And people saw destruction in value. People kind of redeemed the maximum in 2008 and 2009, right? At the bottom, right? When actually it was the time to invest. So it's good to say that you should invest in panic and kind of go out and do that kind of timing stuff. But to be very honest, it's not possible from a human psychology perspective, right? Theoretical knowledge apart, from a practical standpoint, when you go and do it, it's not possible. So how do you kind of do that kind of change? Is when you are able or you have the ability or capability to sustain that market through those cycles. And long short is one of those kind of tool set, right? When you are doing long short, you have the ability to go short, you have the ability to go long, and you are long short simultaneously. Then the comfort of those kind of drawdowns, is pretty much on your side, and you can sustain with that investment for a very long period of time. So moot point, or in essential summary, I would say that timing, of course, when you do it properly, you'll get supernatural or super profits. But it is extremely difficult to sustain over a longer period of time. Long short is a fantastic tool which can actually get you to the returns of a long-term equity or long-term whatever asset class you are looking for.
Right. So idea is definitely very, very appealing, and it is kind of evidenced by a lot of data. However, executing the idea is the key. All of us understand this. Now, going to the execution part, when it comes to a long only fund, I can understand that, the culture of a long only company or a long only team led by a fund managers like you would be talking about economy, talking about, reforms, and always being more or less bullish. And there are companies who talk about we are in golden decade, we are in the best times. But when it comes to managing a team of long short fund, what is the kind of culture that you would have? Because, you are long as well as short. How is it that in your team, that you get your buy side and sell side, data, and how do you take decisions? So ultimately, you are kind of trying to be bullish and bearish. So isn't this confusing? How do you manage that in your team? Question to you, Harsh.
Oh, well, frankly, it's not at all confusing. There are, very, very few scenarios or very, very few phases when you feel really bullish about everything or when you feel really bearish about everything. I think if you're seeing the things objectively, and when I say objectively, you're kind of looking at what is happening at Indian economy, what is happening at global economy, what are the companies saying, how are their earnings panning out, what is the margin picture looking like, all kinds of stuff put together which influences equity returns. So when you consider all that, picture is never super bullish every time, nor is it super bearish every time. You will always have positives and negatives. And if you were to look or scan at broader company level, you will find that X company is doing better than Y, or let's say certain sectors are doing better versus the others. And in fact, that is how we look at it, and that's what we try to focus on. And when you focus on trying to see good and bad at the same time, you are able to get your stocks right. There are few instances, Kamal, when what happens is that you get a lot of positive news. So that is the time when equity markets start rising very fast or start galloping very fast because you don't have any bad news. So that's the time you actually step up the gas and increase your long bets. So in while building the team, what we are looking for is for the team to be unbiased. They should look the data, they should look at the companies and then try to figure out which company is doing better versus the other. So obviously an analyst who is, let's say, looking at 10, 20 companies, he will be able to form a view on those 20 companies. He will not be able to form a view about the market. But as a fund manager, you are looking at 200 companies. So now the data points that are getting out of 200 companies, if they are overwhelmingly positive, you kind of understand, yeah, your position has to go more on the long side than on the short side. So you always have that objectivity in mind that, there will be, phases when things will be good. There will be phases that things will not be good. And by and large, most of the phases will have both. There will be companies or sectors that will be doing better. There will be companies that will not be doing well. And it's a hard truth. I mean, I think, you have grown in North India. I've also grown in North India. From our childhood, we would have seen multiple businesses failing. We would have also seen multiple businesses and our relatives flourishing. So I think there is no one way track that people will only succeed or people will only fail. Same thing happens in businesses. There will be multiple businesses which will do extraordinarily well. There will be many businesses which will succumb to competition and will go down. I think that is the way you should look at equities as well. And when you look at equities that way, you will be able to get your stocks right. In fact, I will tell you that, when you approach markets with that kind of a style or orientation or unbiased approach, you will be able to make a very good long only portfolio when you're not thinking that everything is bullish. In fact, you should think that the market support will not be there at all. Let's say if the markets were to remain flat for 10 years or 20 years, then how is it going to be that I'm going to make money on my stocks? So I have to buy the companies that will go up irrespective of the market. So even if the markets were to remain flat, my company should go up, my stock should go up. That is the approach that you should approach investing with.
Right, Harsh. Rajesh, I agree to whatever Harsh has mentioned, and I'm sure you would also concur with him. But when it comes to, again, putting myself in investor's shoe, I would again have this subsequent thought in my mind that because, you as a fund manager and your team, as a long short fund management team, is trying to have a both side view, and both side view could be possible at all points of time, as Harsh mentioned. Would that not lead to maybe an additional risk in the portfolio? Though we are trying to position the portfolio as relatively lower on risk, as a different asset class, different than long only equities. But because we are trying to kind of do both sides, the possibilities of going wrong are more. You could go wrong on both sides.
Right. I think embedded in your question is the skill sets required in a long short fund manager is far higher than a long only manager. And I would agree with that. The intensity and skill set for a long short manager is far higher than a long short manager. Now, and the other assumption that you have in your question is that if markets are going up or down, is that confusing your asset allocation within sectors? Markets may be going up or down, but sectoral dispersion still exists. There may be some sectors which are going up and some sectors which are going down. If you ask a long only guy, he will be telling you, even in a recession or a downturn, there are some sectors which are going up. Vice versa as well. Even in a bull market, there are some sectors which are going down. Now, so basically, let us say if the challenge is inflation today, I can identify businesses which can navigate the inflation environment well. Let us say in the current context, if it is, as prices are coming off, consumer stocks have done well, let's say over the last 10 days or, 15 days, right? And there would be some businesses which are getting impacted. Let us say like commodity companies have been coming off. So even in that same construct, there is a dispersion of sectoral return. I can identify sectors which can do well and at the same time, which can be very challenging. Now, you look at the theoretical construct. Let us say if I am long a strong company which I believe is going to rise on a bottom-up basis, right? And let us say if there is a company that I believe will fall in a current environment and it's expensive, right? If I am long that company of, let us say 50 rupees, and I'm short another weak company worth 50 rupees, the theoretical construct should be that I have taken out the market risk totally. If the market goes down, my strong company will not go down as much as my weak company. And vice versa. If the market goes up, my strong company will do better than my weak company. So actually, I've taken the market risk totally out, and I have enhanced my alpha generating skills, which is stock picking skills. And I would want to just dwell a little bit on this shorting aspect, which you don't get in a long only fund. This is one of the best times to have a short book, because today several businesses are getting disrupted by technology, right? So if you look at, let us say, even the broadcasting business, which I've been talking about, that the valuations of those companies have collapsed. They used to be 35 price earnings stocks. Now they're at 10 to 15 times because YouTube, Facebook, OTT platforms are taking away or cannibalizing some of the advertising dollars, right? If you look at automobile companies, even gas distribution, it is going to get impacted by EVs, right? If you look at fintech, there is a threat that whether it could take away some part of fee businesses or banks. Amazon can take away, organized retailing dollars. So there is a threat of technology disruption, and it is being faced by every business that you're talking about. What can a long only guy do? He'll say that I will take this away from my canvas. What can a long short guy do? He can actually enhance his stock picking skills by shorting some of these businesses, right? So in fact, if you notice in the last 30, 40, 50 days, the narratives of so many sectors have changed to the downside. Cement business narrative changed because an aggressive player came into the business. Diagnostic narrative changed when one very large player reduced DOP prices. The commodity narrative changed as soon as the government imposed a export duty. The oil narrative changed as soon as the government imposed a certain tax. So many narratives changed in the last 30, 40, 50 days, which a short book could take advantage of. What can a long only guy do? A diversified portfolio for long only would be suffering from this narrative change. Whereas a short book can take advantage of these changes in narrative. So it's a very advantageous book to have as you move forward.
Right, Rajesh. I think this is well said. Vaibhav, moving on to you, you manage the largest fund in the long short category. I want to understand from you, because you manage the largest fund and it is one of the oldest funds also. One, when Rajesh and Harsh are conveying that from their point of view, they are absolutely kind of neutral on market. They are trying to see sectors and trying to see businesses and trying to base their argument of being bullish and bearish on those grounds. And they have relatively no view on markets. So when it comes to you as managing a very large size fund, does the same process of trying to do long short purely on businesses and sectors apply, or you have to kind of definitely have a market view also?
So, Kamal, I think the beauty of long short is basically that everybody in their own comfort can have their own strategy amidst the long short to kind of generate that risk adjusted return. For us, when we talk about long short mindset, I'm quoting mindset here more importantly purely because that is an approach which requires cultivation, which requires huge amount of education, experience, and tracking of markets. When I talk about markets, both macro, micro, global, and local as well, right? And it's extremely important to have that kind of overarching, understanding of things. Of course, you will not be able to go in depth in every area, but general understanding about each of these variables is extremely, extremely important. While you have that understanding, while you have that mindset, you have to translate that as well into a process of investments, which you can repeatedly do again and again and again with same consistency, right? So these are the essential elements which kind of has made us successful, at least relatively, in terms of having managed the kind of funds which we are managing, and hopefully going forward much higher amounts as well. So for an investor, if I am an investor, I would always be looking at one, the mindset of the managers, two, the process of investing, wherein that it is not completely one person dependent. It is an institution which can create that track record on a consistent basis going forward, right? So those are the elements for us which are extremely important. I'm not saying Harsh and Rajesh both have made very, very relevant points, but I would say, taking a step back, please look at the quality of an institutional approach as well for generating those kind of returns.
Vaibhav, a cross question to you, because this is again a question which is asked by a lot of clients, that does size of fund in terms of AUM impact the alpha creation when it comes to doing long short strategies?
See, alpha creation in what sense? I mean, are we looking at generating a debt alpha return or an equity alpha return? What are the subsequent risks associated with each of those strategies? All have to be looked at into that perspective. For our flagship fund, we've always been very, very conservative, and we've always, increased our AUM in a very, very gradual manner, because we, at any given point in time, didn't want to kind of just keep on accepting money at the cost of the, compromising on the risk and return objective of the fund. So we are not asset gatherers. We would be gradual in our approach in terms of, increasing the size. And to answer your question again, size may matter depending upon what is the kind of return generation you are willing to do. Now, if you want to generate returns with a volatility profile which is close to about 3 to 5%, or which you have to have a strategy which looks at very minimal drawdown, of course, at some point in time, size would be a limitation. You have to increase the revenue pool, you have to go in depth. And as the market kind of gets even more liquid, you will be able to generate, but that's a very gradual process. At the same time, if you're looking to a strategy which is a risk strategy and focuses on enhancing the return rather than much of controlling the risk aspect, then the size of the pot can be much, much larger, right? So, so it depends on the construct of the product, the risk return profile of the strategy, the process of achieving that, which will probably determine what is the asset size you may reach at, in the medium term.
Sure. So we have last 6 minutes, and this entire 2-day event that we are doing, the topic of this event is summer of 22 equities in the air. And every other fund manager is a long only fund manager, and every other fund manager is bullish. So it goes without saying, you are long short fund managers, and hence you are unbiased. So to kind of do justice to the event, I want your views over maybe 2 minutes each. What are your views on equity as an asset class? If you want to divide that view, maybe in sectors, that is your call. But kindly stick to 2 minutes each, starting from Harsh.
Frankly, I'm always bullish and bearish at the same time. I'm never supremely bullish nor supremely bearish. But yeah, I do see, things which are wrong, which can go wrong. I'm cognizant of that. And I see things where things really look good. My personal view on, let's say, equity markets per se, let's say on Nifty in particular, over the next 1 year really, that it might give you sub 10 or 10% sort of a return. Over a longer period of time, it might be slightly higher, but it will not be dramatically different from what it has been in the past, which is about, again, 12% sort of returns. I think if you were to look at forecasted returns from here on, compare them with historical returns, your future returns will probably be lower than your historical returns. That's my unbiased view.
Sure. Rajesh, what sectors you want to kind of give your opinion on within this?
Well, I don't know if I want to dwell too much on sectors at this moment, but what I want to kind of say is that long short managers are far more risk aware, and I think your question embedded that long only managers have one view, which is stay bullish. It's far better in markets not to be optimistic or pessimistic, but be a realistic person, right? We are truth seekers in the market. We want to know what is the reality. And I think long short managers are more suited to seeking reality and not distorting their view because of their inherent incentive and bias, right? So I think to understand risk management, long short managers are far more risk aware as to what environment that we are in. So that's number one. Second is, I think we must recognize that the laws of economics and markets have changed with the unleashing of liquidity by global central bankers. I think this is underappreciated because a lot of long money managers clearly don't even track macro, right? Some are even proud of it. So basically, but this is a macro driven market. The laws of economics have changed and markets are being far more driven by global central bank policy than, bottom up, right? And I think that is an environment that we are going to be in as far as the next 3 to 5 years are concerned. As far as India is concerned, I think, look, the current environment that we are going through is imported inflation, right? We don't have challenges of our own inflation in our economy. We are slack in our economy, right? But all of this is imported inflation. And the most important commodity for us is going to be really oil. Now, if where oil goes is going to seriously affect our prospects. So God forbid if, there has been a lot of underinvestment in oil because of this energy transition to, ESG metrics. And given the war with Russia, it makes me a little nervous as to where oil could be. Fortunately, if oil falls to $50, $60 as one firm believes, great. I think that's going to be a phenomenal construct for India. Interest rates will not go up for India as much as they will have to for the developed world. We will start an economic cycle in India, which is going to be very, very healthy. By the way, I'm also equally bullish on India over the next 3, 5, 10 years. But I think in the shorter term, where oil goes matters. If oil goes to $150, it will seriously impact our macro, balance of payment, fiscal deficit, and monetary policy flexibility. So I think if there is one variable that you need to watch, and as you move forward for Indian markets is concerned, it is oil price.
Right. Over to you, Vaibhav. What are your views?
So I think, from a view perspective for the last 9 months, everybody of us has seen the pain in the market, right? And let's understand the reason for that essentially is the global inflation and to some extent what Rajesh mentioned about oil. We do think that inflation has clearly peaked out. Whether it happens from a base effect, I think it can probably change from September onwards. But we've seen commodities correcting by about 25-30%, barring oil. And oil is just a matter of time when, in a world where the growth forecasts are kind of aggressively brought down, we do think that the oil prices cannot sustain those kind of higher levels. So we clearly believe that inflation is peaked out, and the kind of hawkish central banks which are there globally would just pull off their pedal, of being hawkishness, probably in a few months, maybe a quarter or two maximum. So in that respect, I definitely do think, and I'm much bullish than both Harsh and Rajesh at this point in time, that post a quarter's time, which can be extremely tricky and choppy, make no mistake about it. Post that, I think we should be in a very, very good time, at least for the couple of years henceforth. In the light that earnings are going to be strong and FPIs would come with a bang.
Thank you, everyone. I think, the crux is that long short as an asset class does make sense for those investors who are not only wanting to believe one side of the view of long only fund managers and want to have a realistic, allocation in their portfolio to kind of contain the downside, because obviously, uncertainty and risk and unpredictability is obviously there and one does not know, and it is a hard earned money, and hence the question of asset allocation. Thank you, everyone, for giving your time today. It has been really a pleasure conversing over this session. Over to you, Aishwarya.
Thank you very much, sir. I have to say thank you for steering such a pertinent topic and navigating it so well. I think it was also a very well-timed topic. So thank you so much for bringing the best thoughts and best wisdom from such able and eminent panelists that we've had for this session. Thank you so much to our panelists, Mr. Harsh Agarwal, Mr. Rajesh Bhatia, and Mr. Vaibhav Sanghavi.